If you thought the sky-high level of housing prices was bad, well, it just got worse, as Justin Trudeau and Chrystia Freeland decided to make things a whole lot more expensive for Canadians by changing the mortgage rules for first-time homebuyers and raising the cap on CMHC-insured mortgages in a bid to unlock housing. But the reality is, these changes are going to make housing significantly more expensive for Canadians, just as the market was actually doing what it was supposed to do, which was act like a market, and housing prices were looking like they might possibly come down. And by the way, this has broad impacts, including on inflation and the Bank of Canada's job to get interest rates lower. Because quite honestly, if we're going to continue to increase the price of houses by doing silly things, well, that's going to make it a lot harder for the Bank of Canada to eventually get inflation all the way under control. So this is clearly a bid to buy votes from young people. Unfortunately, they already legalized marijuana, so hey, you can't do that again, buy the votes. So this time it's all about housing, and this is very much a bait and switch, and I'll explain how in a second. But before I get into it, my name is Nolan Matthias, and if you want to thrive financially, if you want the latest Canadian real estate and financial news, this is the place for you. So do me a favor, hit that subscribe button, hit the like button so more people like you can see this video. And by the way, there was supposed to be a rate update today on this channel. That's gone out the window. If you want to see that, I'm going to put out in a couple of days now. Make sure you hit the subscribe button and the notification bell, and you'll get that in a couple of days. So let's jump into it. Let's talk about these rule changes and how ridiculous they are. So first, let's start by full disclosure here. As a mortgage broker, yes, I'm a mortgage broker. Many of you, for some reason, think I'm a realtor, but I'm the founder of a company called Mortgage 360, the first B Corp certified mortgage company in North America. That's a certification all around transparency and accountability. So I'm going to be transparent about what's going on here. This does help my business. It makes mortgages bigger. It makes mortgages easier to get. This is a good thing for my business, but it's a bad thing in the long run for the Canadian housing market, especially from a price perspective. So let's jump in here and take a look at the news. This is from BNN Bloomberg. I'm going to show you exactly how this impacts how much a house is actually going to cost you at the end of this video, so stay tuned for that. Trudeau loosens mortgage rules in a bid to woo younger voters. And this is the headline. BNN got this right. This isn't Trudeau makes it easier for younger borrowers. This isn't Trudeau made mortgages easier to get. This is Trudeau did X to do Y, and Y is to try to get a little bit of momentum back. Some of the momentum that he's clearly lost over the last couple of years. I'm going to tell you right now, it's probably time for an election. I'm politically agnostic, but this one's ridiculous. So let's dig into the topic here. And Prime Minister Justin Trudeau's government will make 30-year mortgages available to all first-time buyers and to buyers of newly built homes as the embattled leader tries to win back the approval of younger Canadians. Sorry, Justin, you've lost it. It's gone. You're never getting it back. This might help a little bit, but this isn't getting you reelected, not a chance. The government will begin allowing mortgage default insurance on homes with up to $1.5 million in value, an increase from the current cap of $1 million. This has $1.1 million here. I think that's the maximum mortgage amount. Must be, I didn't do the math on this before I did the video. And this is utterly absurd, because what this is saying is that now if you want to buy a home over $1 million, you can do it with 5% down, which I'll get to in a second, a little bit of the data on average home prices and why this shouldn't be a number that is available to first-time homebuyers and only to first-time homebuyers. We're now making the boldest mortgage reforms in decades to unlock home ownership for younger Canadians. They've said this before. They've done other bold stuff like the first-time whatever program that got canceled that nobody used, where they were taking equity, a share in the equity of properties. But hey, they've done other bold stuff before. This is, again, the government spending more, creating more inflation, and making everyone's lives significantly harder. Now, the move will take effect December 15th. 30-year amortizations on insured mortgages are only for first-time borrowers or, in April, Trudeau and Freeland took a step forward, allowing 30-year amortizations on insured mortgages only for first-time buyers purchasing newly built homes, which it turns out was 4% of the market. Monday's announcement will significantly expand the pool of buyers who can access 30-year loans, which substantially lowers monthly payments. I'm going to show you how it substantially increases costs in a couple minutes here. But insured first-time buyers represent roughly 20% of the market in Canada, while new builds make up about 4%. So they're clearly targeting the 20% of people who think housing is out of reach and unaffordable. I'm going to tell you right now, this makes it more unaffordable, but it makes the payments lower so you can buy more homes, which will increase or put upward pressure on the prices of homes, which are going to eventually make them more unaffordable again. Now, housing prices in Canada, and this is why this is such a ridiculous change. Housing prices in Canada have doubled since then, with the average price in August reaching 1.1 million in Toronto and 1.3 million in Vancouver. Now, emphasis on the average price. So here's what we're doing is we're saying we want first-time homebuyers to be able to buy a property up to $1.5 million with 5% or 7% or whatever the number works out to be down. And here's the thing, is a first-time homebuyer, the people that this is targeted at, they should not be buying average homes. Haven't you ever heard of a starter home? The property ladder. You should be entering at the lower end of the market, not the middle or the higher end of the market. And the fact that this is increasing out to 30-year amortizations just puts upward pressure on the entire market anyways. As the lower end stuff, this creates more demand for the average and the lower end homes. That's going to put upward pressure on all prices across Canada. And all this is doing is it's just eventually going to move the needle higher on what an average home is. And it's really not going to change very much how much somebody can afford. The payments that they can afford are still going to be the same, but now they're buying significantly more. They're taking on significantly more debt, and that's going to be problematic. Now, when pressed by the media, she pushed back against questions from reporters about whether the moves would juice the housing market and saddle younger Canadians with more debt. She said the government has also put forward initiatives to boost supply, including funding to push municipalities to allow more dense zonings and cut red tape. So basically what they're saying here is she dodged the question. Is this going to juice the market? Yes, absolutely. Is the market coming down right now? Yes, in some markets it is. But this is going to put a false floor on where the prices should have come down to. And the best thing that could have happened to the real estate market is prices came down to where they should be, where the market demand and supply meet each other. What this does is it creates more demand for housing, which if you have ever done Economics 101, you will understand that supply and demand, when you shift demand up, it increases prices. That's what this is going to do. So eventually, any changes that they make are eventually going to end up having essentially people pay the exact same amount from a payment perspective, but over a longer period of time. And subsequently, they're going to end up paying significantly more over their lifetimes for houses. So what this is all about is putting the dream of home ownership in reach for younger Canadians, giving first-time buyers a leg up in the housing market. The best thing that the government could have done was let the market come back down so that houses were actually more affordable for young Canadians without saddling them with higher levels of debt, without saddling them with essentially more interest costs over the life of the mortgage, and without saddling them with an artificially inflated housing market where you have higher prices than what they should be. Now, I told you that I would show you exactly what this means for first-time homebuyers or people who take a 30-year amortization. I want to show you that right now. So I'm going to pop you over into here, and I'm going to show you our mortgage app. You can download this totally for free. You can play with all the numbers, look at the numbers for yourself. You just go to the link in the description below. And I just want to show you what this looks like from a total cost perspective. So let's say we start with a 25-year amortization. We're going to start with a $500,000 mortgage here. So as of right now, the payment would be $2,767. The total cost, the total paid over the life of the mortgage, if you take a look right here, is going to be $830,000. And that's substantial, right? So over the next 25 years, somebody's going to pay $830,000, which is a lot. It's a lot more than what they're paying for the actual home. Now, I want to show you what happens when we increase your amortization out to 30 years. This is what happens. It goes up to $907,000. Now, as you can see, the payment doesn't actually come down that much. It comes down a little bit, but not a ton. But the interest costs, they go up pretty substantially. Now, what happens if I push this out to a $1.1 million mortgage, which is the maximum you're going to be able to get with 5% down? Well, take a look what happens now. Total cost on a property that you purchased with a $1.1 million mortgage is going to be $1,996,000. This doesn't include the down payment. And it doesn't include the total cost of ownership and everything else, but you get the idea. Now, see what happens when we come down to 25 years? Brings it down to $1.826 million. The change is pretty substantial for a little bit of a benefit. But the real problem here isn't the extra 50 or 100,000 or $200,000 in interest costs. The real problem is the fact that this is going to make houses in Canada significantly less affordable because this is going to create more demand and it is going to prop up, or as they put it in this article, it's going to juice the market. And when you juice the market, you create an artificial floor. And instead of housing prices coming down and the total overall cost being way less as a result, what we end up now with as homes that are either going to stay at pretty similar prices or go up in value, plus the option to pay an insane amount of more interest than what you should have. So this is pretty wild. I think, like I said, this is good for my business, but bad for the Canadian real estate market. I think these guys got to go, and that's clear. And by the way, if you want to see another video on some of the crazy stuff that's going on in the Canadian real estate market, especially with the Toronto condo market, make sure you check out this video right here.